Well, good morning. I'd like to start the presentation by sharing with you a communication that I had with my readers actually at 3 o'clock in the morning. I flew straight through from New York, so my evenings are spent watching out the window. What I said was, as you know, we had a very significant drop in the price of gold yesterday. And I said, Chair Yellen has placed herself between the rock of recession and the hard place of playing the hawk. A global recession cannot produce an isolated USA, but rather underscore the heart of the recent USA economic figures as a reflection of insular American economy following the world back into recession, not entirely of the extremely cold weather related. You might note that China has not had as much of a weather problem, yet is experiencing degrees of contraction in a spectacular rate of growth previously present. The idea that stimulation, even if only in form but not reality, can be withdrawn in the US without draconian economic results is simply false. Chair Yellen is truly dedicated to full employment, is going to go into shock over the next short few months at the divergence between her economic modeling, behavioral economic projections, and the degree of economic contraction in the United States. She will revert to her long-standing dovish viewpoint of full employment and a 2% inflation mandate of the Federal Reserve and move this hyper-stimulation that we've had, $4 trillion, into higher gear than even before. Both the stock market and the gold market will reflect this in substantially higher prices. One should never forget that the wheels of the equity markets and the gold market is liquidity, which represents debt presently and nothing more. I'm presently writing this in Hong Kong, looking out my window in contemplation of mainland China, where nothing has changed. China may look like a free enterprise exercise, but it's far from it. This is a Maoist country which will handle the contraction of its economic activity in a much different way than the hordes of Ivy League analysts populating Wall Street, the city, and Bahnhofstrasse believe. There will be a unified pulling together of the function economic to prevent the dire circumstances the uninformed love to paint China with and have been for the better part of a decade. The only asset to service and appreciation, the only asset to service and appreciation in period that we're going into is the great leveling now in progress in the West. This is understood at a level of policy here in the East in the purchase of gold. Gold is not being brought here in the physical market as an investment decision, but rather as a policy decision. And it's clearly understood that gold is for savings and not for speculation, as the eventual failure of the paper gold markets will prove beyond any form of doubt. As we move out of the great leveling in 2016 into the great reset of 2020, we'll have preserved the buying power of those courageous enough to hold and possibly add to their position. Companies holding gold free of the tentacles of the West will prosper accordingly. The developments in Crimea are a well-timed stratagem to prevent the adoption of the TITT treaty that no one wants, and the ability to turn Euroland into a dollar-dependent trading area. The Baroness and Mr. O'Sullivan have more to do with what's going on in the Crimea than the organized and false demonstrations are blamed for. The US dollar knows this and can be seen to have lost its snapback mojo from below the 0.80 on the USDX level back into the area of 0.81 to 0.85. It is even struggling today as a stratagem to bring down the euro and the Euroland has been trumped by the ongoing moves of Mr. Putin. Stay the course in gold and it will benefit you mightily. This is a note sent to my readers last night because of their interest obviously in the market and wanting to know what was happening and what its implications are. The very important criteria is that even with gold down very sharply yesterday, the US dollar was equally lower. that the product that we deal in, the product that we take out of the ground, is not something that can be controlled eternally by the paper markets. That in fact, that what we take out of the ground is a universal savings mechanism. And that is more understood here in the East than it is anywhere in the West. I traded gold in the 1970s and was considered at that period of time to be the largest influence in the markets. So in a sense, I can give you the view of the person who makes the price of the markets move and to whom paper is the medium. Without the paper markets, the ability to go in and to offer a year-and-a-half supply in an illiquid period of 20 minutes is totally impossible. The future of the paper markets depends on the character and the future of their warehouses. A futures market without a warehouse can't function. A futures market without a warehouse won't default. A futures market without a warehouse will in fact convert to a cash market. As it converts to a cash market, it will lose its ability to trade volume because the hedge position and the bank lending to the hedge position will find that the rules and regulations of lending do not found that hedge activity, but rather act almost as an option market. The reason why I go into this before we go into bail-in is because it's a timely subject. The key in what we're watching now is watch the dollar market. The battle to be fought is in the dollar market, not in the gold market. The present price of gold has fallen yesterday into support. There's significant support between the 1220 and 1250 area, which in my opinion would be an absolute bottom to the secondary reaction, yielding a third bottom at a higher level and technically confirming the bull phase that gold, in my opinion, is in, which nobody else holds that significant opinion. Now, what the subject of this presentation is in a very unfortunate sense, how everyone in this audience here is going to be shocked by what's going to happen in your banking accounts. You have to realize that when you deposit money in a bank, you are not holding an asset. When you deposit money in a bank, what you're doing is you become an unsecured lender to that institution. And as an unsecured lender to that institution, what happens to the institution is exactly what will result in what happens to your assets. Now that I found the ability to change the slide, it's a little bit glib, but it's really the truth. As you deposit money into a bank or institution, you no longer have the asset. And the bank, it becomes the asset of the bank or institution, and by definition, you are an unsecured lender. Money, when paid into the bank, ceases altogether to be the money of the principal, and is by then the money of the banker, and this is case law, dating back to 1848 and as powerful today as it was back in history. Our experience that is popular in your mind is the experience that took place in Cyprus. And in Cyprus, you must understand that the losses that the banks have carried, when they exceed the capital of the bank, invade the capital of the depositor. That's you. And the real problem that exists is a product of the over-the-counter derivatives that were created from 1991 to 2006 and are best known as legacy derivatives. And these were in March of 2009 relieved of the responsibility for mark-to-market, and the banks and institutions were allowed to value these as they chose, as they saw fit. And what that did was create a difference between the real value of what was held by the banks and institutions and what was on the balance sheets. As far as too big to fail is concerned, the only difference now from 2009 to present on too big to fail is, in fact, they've become bigger. And of the amount of banks that took bail-in took bail-out and TARP payments results in 900 institutions that still value their over-the-counter derivatives of a legacy nature, according to FASB, the Standards Bureau, at whatever they choose to value them at. The point that I'm trying to make to you is that the problems that existed in 2000 and 2008 and 2009 continue to exist. The Financial Standards Board is the guards of accounting, those who set the standards that result in the balance sheets that you read, those that set the standards of all the accounting you do, those that have allowed the banks and institutions to maintain their value of the over-the-counter derivatives that they hold at the value that they choose. Bail-in is the biggest risk that we presently have, the biggest risk that you presently have. One of the best reasons for the price of gold, one of the best reasons why the price of gold, in my opinion, is in a significant uptrend. It is written into law. The FDIC and the Bank of England have issued a paper which specifically says that the taxpayers will be relieved of the responsibility of financing any failed bank by the fact that the losses will be absorbed by the depositors. This is what you need to understand, and it is not a simple problem that is isolated to a place like Cyprus or to some small island, but exists in almost every country of the Western world. It is written into law. It's written into documented paper. It's nothing that you can't go to Google and find out for yourself, prove for yourself beyond any shadow of a doubt. But where do we go from here? My answer is that we need to get out of the system and consider diversification into other systems, basically in investment towards the BRICS. More importantly, this is a chart of the US dollar over 33 years. And you can see that since 2000, the US dollar has been playing catch-up action. You can see the symmetry of the channels that they're involved in. You need to recognize that Mr. Putin holds in his hands the draconian economic weapon of the ability to settle energy in any currency he chooses to, and the dollar. We have to remember that in 1972, when the dollar came off the gold standard, that Nixon put us on to what is the energy standard. That is that universally contracts in energy are settled in US dollars. All that Mr. Putin has to do is to say that he'd be very happy to accept any currency, including the US dollar, to put the petrodollar into question and to fulfill this technical analysis which says that the US dollar, in fact, is going substantively lower. That the objective 0.76 on the USDX as well as 0.72 on the USDX are real and viable objectives, and if you'll only look at the market of yesterday, you'll see that with gold falling sharply, the dollar fell sharply. A contradiction in terms if you don't understand the reason why. The next chart is what we mine. It is a picture of the pillars that affect the gold price. It's a recognition of a top in the US dollar. It's relative trust in paper assets declining. It requires a relatively bullish commodity market. It requires triple